Hey guys, Chris from Adapt Tuition here, and in this video I'm going to show you how to prepare an income statement catering for adjustments for accruals and prepayments, provision for bad debts, and the provision for depreciation. If you are not too familiar with the adjustments and you need to get a feel for them, then I'm going to put a card up here that will carry you to a playlist that shows you the videos that I made previously, and those videos will show you how to deal with each of the adjustments individually. Also, I'm not going to have very detailed cost of goods sold or cost of sales sections. I'm just going to have one line for it. That's because I just want to make sure we get straight to the adjustments, because that is where a lot of people have difficulties. Now, if you're having difficulties with the cost of goods sold section, the trading section, that's fine, that happens. I'm going to link a video in the description below where I show you step by step how to prepare that cost of goods sold section. It can be a bit mean, it can be a bit difficult, but with focus, concentration, and practice, you can get it. All right, guys? So if you've checked out those videos before and you feel comfortable and ready to check out this video where I combine all the adjustments, let's begin. All right, guys, so first thing to do as per usual is take a read of the information the question gives you. Let's go. So we're seeing here on the left hand side, prepare the income statement of all of the adjustments for the year ended 31st May 2018. So we are given a basic table. It's not a trial balance, there's no debit and credit column, so please be mindful of that. And we are given a list of some items down here. Now, always be sure to check below that information for your additional information. That's going to tell you what the adjustments you have to make are, and well, yeah, that's what you need to check out. So please be sure to check out the additional information below the major or main set of information. So what we're going to do is we're just going to go through the question, and as we go along, we're going to take a look at the adjustments to see if we have to adjust and how much. As a matter of fact, let me go back down there so we can have that visible all the time. All right, so when we are doing an income statement, the first thing we have to do is head it up properly. Always put your headings, please. They get marks. Now, I've been taking a look at some of the recent past papers, and the space seems to be very, very exact and very tight. So just some people, what I normally, like I'm going to show you now, what I normally do is I put my headings as such. I head up with the name of the entity, in this case all of the adjustments, the name of the statement, in this case the income statement, and the period to which it applies, which is for the year ended 31st May 2018. What I've seen some people doing is putting it in a single straight line going across. I can't say whether or not this is totally acceptable, but it seems to be a nice prudent way to approach space maximization, as a matter of fact. All right. Okay. So that being said, let's get into the information. So the first thing we're seeing, and that goes in the income statement, is sales revenue. In this case, our sales revenue is $190,000. From that, we subtract our cost of goods sold, or as we're seeing here, cost of sales, which is $30,000. So sales minus cost of sales will give us a gross profit. In this case, our gross profit is $160,000. To that, you can add other revenue. Now, I have seen some income statements where the expenses are subtracted first and the other revenues added after. That's also fine. As far as I know, there is no one right way to do an income statement. There are wrong ways to do it, so just be careful. Don't go and tell the teacher, oh, well, Chris from Adapt Tuition say I can do what I want. That's not what I'm saying. Okay, if you want to find out more about it, check out iasb.org and look up the IAS's, the International Accounting Standards, and the IFRS's, International Financial Reporting Standards, and take a read, have a leisurely read of this lovely information to see exactly if there is a fixed format. Spoiler alert, it says there is no fixed format. All right, so what are some revenue items? I'm seeing a couple of revenue items. The first one I'm seeing is rent revenue, but I'm also seeing the first a piece of additional information is accrued rent revenue. Now, what do we do with an accrued item? Well, we add it. All right, so you're going to see $7,000, which is the rent revenue from the above information, plus the $3,000 from the additional information. And $7,000 and $3,000 will give us $10,000. Now, why do we add accrued portions? So let's talk about it very quickly, because I've covered this in a previous video. To calculate profit, we have to match revenue earned in a period with the expenses incurred. We're talking about rent revenue here. Now, we've earned $10,000. How do we know that? Because the information on the left above says rent revenue $7,000. That's rent revenue received. And down here, it says rent revenue accrued, which means earned but not received or not collected. And regardless of whether you've received the money or not, the point of the matter is that you've earned it. And once you've earned it, regardless of if you receive some, none, or all, the total amount earned goes in the income statement. So that's why we add accrued portions of revenues, or expenses for that matter of fact. The next revenue item I'm seeing is commission revenue. Commission revenue says 12,000 in the upper portion of the information, but in the portion below, the additional information, I'm seeing it says prepaid. Now, what do we do with a prepayment? Well, what is a prepayment? A prepayment is an amount that we, in this case, in revenue, we received it in advance of earning it, which means we have not yet earned it. And thus, we cannot put something we've not yet earned in the income statement, which means we have to subtract it. Long story short, we have to subtract the prepayments. And in this case, 12,000 minus 2,000 will give us 10,000 again. So we happen to have the same net figure there, right? That was actually done for the sake of simplicity. I'm hoping it's not confusing anybody. I apologize if it is. So we add up our revenues, our other revenues, we're going to get 20,000, and we add that to the gross profit because revenues increase profit. That's going to give us 180,000. Now from there, we have to start subtracting our expenses. So what I'm going to do, I'm going to go across here, I'm going to scroll down so we can see all of the other information in the question. All right, lovely. The first expense item I'm seeing is electricity. Now, if we look down in the additional information, the third item says accrued electricity. And what do we do with accruals? We have to add them. So 14,000 and 1,000 will give us 15,000. Why do we add accrued portions of expenses? Once again, to calculate revenue, you have to subtract, you have to take revenue earned, to calculate profit, you have to take revenue earned and subtract expenses incurred. The expenses incurred, regardless of how much you actually paid, if any at all. So the information on top here says that we paid out 14,000, but the information below here says that we did not pay 1,000, which means that we need to put it in the income statement. It was incurred, but not paid. So regardless of if it is paid or not, it has to go here. So that's why we add the accrued portions. Okay, next item, I'm seeing salaries. Now it says salaries 29,000 on top, but I'm seeing the fourth item below says prepaid salaries. Now what do we do with prepayments? We subtract them. Why do we subtract them? In this case, it's an expense paid before it was incurred. If it wasn't incurred in the current period, it cannot therefore logically form part of the current period's profit calculation, so it needs to be extracted, or as we might say here, subtracted. So we subtract prepayments. Next item I'm seeing is the provision for bad debts. Right, so this of course is a troublesome item. Let's take it one step at a time. The amount that goes in the income statement in respect of the provision for bad debts is the change in the provision from one period to the next. How do we assess the change? I'm glad you asked that question. We have two things to do. We have to compare the new provision with the existing provision. In the upper part of the information, you're going to see provision for bad debts 3,000. That's the existing provision. The new provision, well, where is that going to come from? Once again, check out your additional information section. Boom. We have the fifth item down, provision for bad debts 10%. Now, that's 10% of debtors or 10% of receivables. I didn't have enough space to put it there, so forgive me, all right? So we have to find 10% of 50,000 and compare it to the existing provision of 3,000. So let's just take a look and see how that calculation will look. All right, so 10% of 50,000 minus 3,000. 10% of 50,000 is 5,000. 5,000 is more than 3,000. How much more? $2,000. And that is the figure that goes in the income statement. The change in the provision from one period to the next. All right, next we have the provision for depreciation. Now, depreciation is charged on non-current assets, or some of you guys may know it, fixed assets. If we look across in our above information here, we have two fixed assets. We have furniture and vehicles. And we also have provision for depreciation on those assets already. Now, what is that provision for depreciation? Do we just take that and put it in the income statement? No. That provision is all of the provision for depreciation previously charged and accumulated on the asset prior to the current period. What we need to do is calculate the current period's depreciation and put it in the income statement. So once again, these figures highlighted here are not the figures that will go in the income statement. Those are the previously charged depreciation figures. So we have to go down here to the additional information section. It says furniture, 25% straight line method. Now, furniture is a non-current asset, and straight line method, what's the calculation? What's the formula? We have to take the percentage and multiply it by the cost of the asset. So that'll look like this, 25% of 80,000. Now please be careful. Always make sure you're multiplying by the cost and not the depreciation figure, right? Sometimes in the questions they'll put, like how I have across here, they have provision for depreciation and then list the assets below. Sometimes they do that with the provision for depreciation in the information, especially if it's a trial balance. And people, a lot of times they mistake that figure for the cost of the asset. So please be careful when you are reading. If it is a trial balance, the asset balance will always be in the debit column because assets have debit balances. The provision will be in the credit column. All right, so let's take a look now. 25% is a quarter of 80 is 20,000, I believe, yeah? All right, sorry, move that. Now, the last thing is the vehicles. So vehicles, it says across here, we have to charge 20% reducing balance method. How do we calculate depreciation under the reducing balance method? Well, we multiply, listen to it, the percentage, the depreciation rate, by the net book value of the asset. Not the cost, the net book value. So your next question should be, what is net book value? Net book value is the difference between the cost of the asset and the existing provision for depreciation. So what that calculation will look like is this, 20% of 625 minus 125. 625 minus 125 is cost minus the existing provision. That's net book value. That's 500,000 in this case. 20%, which is a fifth of that, will give us 100,000. I think I'm missing a zero. Yeah. Okay, so now we're going to total up all our expenses, which will give us 162,000, and we're going to subtract that from the above 180, which will give us a net income or net profit of 18,000. All right, so if you need to go back over this portion of the video, please do so. If you have any questions as you go along, pause the video and put them in the comments below. I'm very happy to answer questions for you guys, right? I know sometimes when I explain things one particular way, it mightn't stick. It happened to me as a student. It happens to me up to these days when I'm doing whatever courses I do online, right? Sometimes how the teacher explains it the first time or the second time or the third time doesn't stick, and we have to have someone else explain it, or hopefully the teacher can explain it a different way so that we can understand it. All right, so if you have any questions, once again, put them in the description below and I will get back to you. I will try very hard to get back to you. Okay, all right, so I want to do a second example, which is very important here because it's going to show what happens when the provision for bad debts decreases. Let's take a look at that. Okay, let's take a look at a second example here. So we start by reading the question. So prepare the income statement of all of the adjustments for the year ended 31st May 2019. So this is the year after the previous example. So just for the sake of simplicity, you'll notice I've kept all of the items the same in terms of the words and the order, but the figures have been changed. All right. Also, once again, so that's the initial information. Where do we get information about the adjustments? In the additional information below. So make sure to go below and read. Sorry, I get into my ET zone there. How many of y'all know what ET is? Check me in the description. Comment in the description if you know what ET is. All right, and you're born after 2000. Don't go and Google it. Actually, you know what? Google it. Why not? Okay, so prepare the income statement of all of the adjustments. So once again, yeah, like I try to sing trap music. I don't know, right? Those who have been following the videos, you'll have been picking up on the little puns in the name, right? Or the little trick in the names. It's kind of been resembling the actual topic. Anyhow, sorry, that's just something I do. I try to be creative with the names. Anyhow, let's get to the work. Sorry about that. So when we're heading up an income statement, we need the name of the entity, all of the adjustments, name of the statement, income statement, and the period to which it applies. In this case, for the year ended 31st May 2019. First item, as per usual, is sales revenue, which in this case is $250,000. From which we subtract our cost of sales, which will give us, which is $40,000. Sales minus cost of sales, or cost of goods sold, as some of you all know it, is gross profit. 250 minus 40 will give us 210. To which we're going to add any other revenues. Now, the first revenue we're seeing is the rent revenue. Go down to the additional information. We'll see we have an accrued portion of 4,000. What do we do with accrued portions? We add them. Accrued starts with an A, add starts with an A. Accrued, add, accrued, add accrued. All right, so I messed up. Cool. So 6,000 plus 4,000 will give us 10,000. That's 1 0 too many, right? 10,000. The next thing we have to do is cater for the commission revenue. So it says 13,000 in the on top piece. In the below piece, we're seeing a prepaid portion. What do we do with prepayments? We subtract them. 13 minus 3 will give us 10,000. Now is the interesting part. The provision for bad debts. Always check out what happens with your provision before you start your question. Ascertain if it increases or decreases. If it increases, we just saw what to do with it in the previous example. Let's see what happens when it decreases. Right, so what do we do? Well, first of all, let's calculate the provision for bad debts. So we need to calculate, it says 10% of debtors. So let's scroll down to see if we see where debtors is. Right, I'm seeing a debtors figure of 40,000 and an existing provision of 5,000. Right, down in the additional information, I'm seeing provision for bad debts 10%. Now that's 10% of debtors. So what's 10% of 40,000? 10% of 40,000 will give us 4,000. 4,000 is 1,000 less than 5,000, which means we have to put that 1,000 up in the other revenue section. That'll give us total other revenue of 21,000. Once again, if at any point in time you're not sure why I did what I did, pause the video, go down, ask the question. If you could put the time when it happened or whatever it is, let me know so I can go back there. If I made a mistake, I can try to fix it or at least add something in the comments below, right? Hopefully I don't have to do it for the whole video, but I don't think that'll be the case, right? Okay, so now we add the 21 to the 210 above, giving us 231, and it's time to start subtracting expenses. First expense I'm seeing is electricity. That's 8,000. We have an accrued portion of 2. What do we do with accruals? We add them. 8,000 and 2,000 will give us 10,000. Next we have salaries. Salaries is 30. Is a prepaid portion of 5. What do we do with prepayments? We subtract them. 30 minus 5 is 25,000. Right, now we've dealt with the provision for bad debts already, so let's get straight to the provision for depreciation. The first non-current asset is furniture. What does it say down here about furniture? Straight line method, 25%. So how do we calculate depreciation under the straight line method? You multiply the rate, the depreciation rate, by the cost of the asset. 25% of 80,000 is a quarter of 80,000, which will give us 20,000. Similarly, vehicles. Now vehicles says reducing balance method. How do you calculate the depreciation charge under the reducing balance method? You multiply the percentage by the net book value. What is net book value? That's cost minus the provision for depreciation previously charged. So that's going to look like this. 20%, the rate, minus the 625, multiplied by the 625 minus 225. 625 minus 225 is 400. 20% is a fifth. A fifth of 400 is 80,000. So those are all of the expenses, totaling 135, and 135 from 231 is a net, will give us an income of 96, I believe. There you go. Right. There you have it. Okay guys, so there you have it. Those were 2 income statements that showed you how to cater for the adjustments for accrued and prepaid revenues and expenditures, the provision for bad debts, both an increase and a decrease, and the provision for depreciation, both the straight line and the reducing balance method. Now, if you need to go over any of those individual adjustments, please be sure to check the link in the description below to that particular video, or the playlist rather, and you can take a look at each one individually and you can focus on it and get your get your questions answered. And once again, if you have any questions on anything I've done in this video, please put it in the description below and I will be sure to get back to you. Okay, so you know what I'm going to say now, right? If you found this video helpful, please give it a thumbs up. If you are liking the content and it's bringing you value, be sure to subscribe and click the little notification icon to be able to know every time I release a new video. And if you think someone else could benefit from this video, please feel free to share it, right? It's not hard. Okay, guys. So remember, you can be anything you want to be. You can do anything you want to do. If you have the correct mindset and you put in the work along the way, you're bound to have trouble. So don't be afraid to ask for help. And if what you're doing isn't working, then adapt, because change is the only constant. All right, guys, thank you so much for watching. I look forward to seeing you in the next video.